There are many risks out there globally that affects market movements and asset prices. We at Ashburton have identified 6 risks that dominates the market actions and the volatility at the moment. If we look at the first risk, let's look at the trade wars. The trade wars are probably the risk at the moment affecting prices most. The trade wars effectively is mainly at the moment between the US and China, where China is running a trade surplus to the US of about $375 billion, and America has introduced some tariffs to try and reduce this. There's a general perception that there might be a deal by the end of this month of March, where hopefully some of the conflict would disappear. However, over the longer term, these two mega economies would probably continue to have disagreements going forward. Secondly, we look at US growth and the impact that has on South African investors. US growth was the star performer of last year. However, in the fourth quarter of last year, their growth numbers also started coming down, causing the equity markets to fall quite sharply in December. Fortunately, this movement has caused the US Federal Reserve to change tact and thereby indicating to the world that they will pause on interest rate movements until further notice. This is quite a change from the previous experience where they've been in a hiking cycle and thereby making the cost of money more expensive. The third risk that is important for South African investors are the Chinese economy and what growth is doing in China. The second half of last year, Chinese growth actually went through quite a bad patch. It softened quite aggressively. But fortunately, authorities have stepped in from a fiscal point of view as well as a monetary point of view. The authorities introduced some measures to try and boost growth. And at this point in time, we are starting to see those efforts coming through into the numbers as well. So for the next year or two, we do expect Chinese growth to slow down somewhat, but we still expect growth for this year at about 6.1%, reaching 6% next year. So although it's a gradual slowdown, we believe the authorities have introduced enough measures to contain growth and not that growth would become a problem to South African investors. The fourth risk is Brexit and European growth. While at Ashburton we don't have a strong conviction view what the outcome would be of Brexit, we don't feel that a hard Brexit exit would be a base case scenario. We think the probability of that scenario is relatively low. What is more important for us as South African investors is that European growth starts picking up. Places like Germany and Italy has really disappointed last year, and we need European growth to pick up slightly to improve the environment for South African investors and emerging markets in general. Moving closer to home, our fifth risk is the elections coming up in May of this year. There's a general perception out there that President Cyril Ramaphosa needs a majority vote to enforce structural reforms that he has been promising us. We at Ashburton believe that he would get that mandate and that he would go on the structural path implementing these reforms. Finally, the sixth risk for South African investors are what the rating agencies are going to do. Moody's are the only rating agency that still rates us as an investment grade, and they are coming to market on the 29th of March to decide our fate. While it is possible for them to give us a downgrade to non-investment grade, we believe it is probably too soon. They might change the outlook from stable to negative, thereby creating about a 12 to 18 month window to evaluate if we are indeed on the structural reform path or not. If we are, then we probably stay investment grade. Otherwise, the likelihood of falling out of the investment grade rating and thereby falling out of some WIGBY indices will increase. So in conclusion, taking all these risks into account, it's easy to see why markets have been this volatile and would probably remain volatile going forward. It is therefore crucially important for an investor to be invested in a well-diversified portfolio who can handle these short-term shocks and to try and stay invested for the long term.